Hello, everyone. I'm Brad Long, Partner and Deputy Chief Investment Officer at Fiducient Advisors. Let's talk a bit about volatility. So it's February of 2022, and we just left January, which is a fairly volatile month. Now, our comments aren't specific to January, and more so a general framework of how to approach volatility, especially in the future. So we want to leave you with three things. First is, how do I set my expectations around volatility? What's the difference between garden variety volatility and bone shaking volatility? The second is, especially in the latter category of volatility, what are the key risks that we want to seek to avoid in those periods of time? And then the third is, what do I practically do about it as an investor? So first, let's help set our expectations. So we look at the S&P 500 dating back to 1980 as a proxy for markets. We can see the light blue line here is calendar returns, and the dark blue dots are the intra-year drawdowns that occur in that calendar year. Now, the average drawdown over that time period is 9.3%. So said another way, and rounding our math a bit, on average, the S&P draws down 10% in a calendar year. So when we're starting to set our expectations, we should start to think about a correction, which is a technical pullback of 10% or more, as the general level of volatility that's normally acceptable, 10% or under. Now, let's talk about the latter category, which happens about 30% of the time of intra-year drawdowns, where it's above that 9.3%. So in those instances, sometimes those years still prove to have positive annual returns. In others, they prove to have negative annual returns, and that's part of the economic cycle. But one of the key risks that we see in those periods of high volatility is changing your game plan in the middle of the game. And so what do we mean by that? Investors that choose to go to cash or change their portfolio allocation in the midst of volatility. So as a way to proxy the cost or the risk of doing that, what we did is we looked back and we said, what if we just miss some of the best days, 5 days, 10 days or more? Now, since 1980, the S&P has had over 10,000 trading days. So we're only talking about the 5 best days, which seems like a small number. But as you can see, if you would have missed the top 5 days, you would have reduced the total value portfolio by 43%. Clearly a high cost. So what do we do to potentially guard against these things? Well, first, let's guard against garden variety volatility with knowledge, right? We've already set our expectations, a 10% drawdown on a calendar year basis. That's normal. We're okay with that. Now, for the non-garden variety type volatilities, there's a couple of things we would say. First is building a well-diversified portfolio can help weather through those periods of time and something we'd highly recommend. Secondly, when setting your portfolio up originally, use plain English. Use things like the potential drawdown, the capital loss, meaning the amount of money lost, or what it does to your investment plan for you as an individual or you as an institution. Translating standard deviation or non-normal returns, those are hard things to compute into how that might actually impact you in those periods of volatility. If you have any other questions about market volatility or how to set up a plan to help best weather those periods, please reach out to Fiducient Advisors. Thank you.